All right, everybody. Tortoise Investing here with Ryan Williams in the flesh and blood. Man has almost 39,000 subs, over 500 videos on his channel. If you haven't, go over check him out, guys. Super amazing dude. He's got so many videos on anything and all dealing with dividends. He's got a website. I'm going to have a link to everything down below for you. And just go check him out. He's super great. Ryan, you want to tell him a little bit
Thank,
about yourself, man?
thank you, man. No, I mean, you pretty much spilled all the beans for me, so I appreciate the introduction, and yeah, I'm just super excited to be chatting with you today. I'm glad to chop it up, talk some stocks.
Oh yeah, absolutely. And I mean, the big surprise this morning is definitely Realty Income. Their big
So, did you
acquisition.
did you check up on the news?
Yeah, I seen it. Was at the Spirit Realty, and I think as of right now they're down about 5%. Are you gonna take? Is this a buying opportunity for you? You gonna grab some more Realty Income?
Yeah, it's been a buying opportunity. I'd say these last couple of months, I've been just slowly adding some more to it, and picking up some more shares as it's come down, kind of catching the falling knife for better for worse. Um, but it's tough. We're getting to a point right now where there are just so many different things you can buy at a discount. I mean, prior to recording here, we were talking about the Hershey Company. You're talking about SCHD. So there's just a lot
Mm-hmm.
of places you can put your money right now, which on one hand is really exciting. It's good to see all these discounts, but on the other hand, it can be a bit overwhelming because you don't know, with all these different potential places to invest, you don't know exactly which ones you should prioritize. So, if I'm gonna, and I've been buying some more Realty Income, but right now I'm also seeing other stocks in my portfolio like Lowe's or Johnson and Johnson, some other ones like that I'm thinking, maybe I'd rather put some more money into those. But man, with Realty Income, over 4% drop so far today, I think that puts them now in the mid $40 range.
Yeah, they're at
It at this
46.21 right now.
Yeah. So with that said, it's also kind of a hard one to pass up. So I'm sure I'll add a little bit more here and there, and also WP Carey. I forgot to mention that one. Once the spinoff goes through there in a couple days, I'll be adding some more to that as well. So yeah,
Are they dropping any
I'd be
today?
surprised. What's that?
Have they dropped any today? Because I know a lot of REITs, they'll kind of follow each other.
I haven't seen what WP Carey's done. I'm sure that they've come down today. I'd be surprised if they didn't. But yeah, in short, to answer your question, I'm sure I'll pick up some Realty Income, keep stacking that along with some of those other ones. But I'll probably, do 1 week Realty Income, 1 week these other ones, and kind of bounce around a little bit.
Oh, absolutely. Good. Just trying to spread it out, diversify.
Exactly, man.
Yeah.
Exactly. Got to take advantage of all these different buying opportunities while you can.
It's tough. I would like to have so many more positions, but I've been very condensed. One ETF. I keep anywhere from 6 to 8 individual holdings. I'm kind of building it up that way. But
Yeah. So the one ETF you have, SDHD, I'm guessing is your like foundational position, and then you just built some others around that, some other individual stocks around that.
yeah, it's my core, and then I got satellite holdings ranging from 14 to 8%, just surrounding it.
Wow. Okay. So which one's the 14%?
Mastercard.
That's a good one.
Yeah,
Okay.
Mastercard is 14. I think Hershey is 12. Extra Space Storage, which is one that's been just dropping like a rock, along with a lot of other real estate income, realty, blah, real estate companies. Um,
Yeah.
yeah, it's down. I think about over 50%, but I'm still just gobbling it up here and there, get my dollar cost averaging down with it.
It's just crazy to see how much some of these stocks have dropped. I just was recording like a portfolio update video yesterday. And in doing so, I look at like the best and worst performing stocks throughout this last month. And I've got a watch list that I've built on Seeking Alpha of like just 80 different stocks just to keep an eye on things.
Mm,
And if you organize that by like the worst performers at the top over the last month, you can just scroll and scroll and scroll and just do not stop. And you see just an abundance of stocks that are down double digits just in the last 30 days. That's just for basically, the month of October. And I remember doing that same thing a month ago at the end of September. And it was the same exact thing. You just keep scrolling. So many stocks down double digits. So Yeah, it's just been pretty wild to see how much some of these stocks have come down in price. I didn't know EXR was down over 50%. Is that year to date, or what's the timeline on
I
that?
think off of their high, they're down
Okay.
around that. I got my phone app here pulled up so I can get a quick year to date update. Year to date, they're down 28.7%.
Wow.
But yeah, the whole
Wow.
interest rates higher for longer have really done in a lot of companies, and it's kind of spilling over. I feel into some of the consumer stocks. I mean, Altria, they're down below $40, and I think they said that higher gas prices at some of the convenience stores could be something that's impacting that as well.
Mm. Yeah, and gas prices right now are being impacted by what's going on in the Middle East from what I've read. And we've seen Chevron, who just announced, well, actually Exxon, I think recently did as well, announced deals that they'd be buying these other companies um, in this space. But Chevron's come down quite a bit, partly because they announced the acquisition of a company called like Hess Corporation, I believe. Um, but also just what's going on in the Middle East that's caused concerns over crude oil supply, which has also impacted um, prices as well there, which affects those stocks.
Yeah, that mixed with the interest rate thing, like a recession. Everyone has been saying that there's going to be a recession for like a year now. Do you see that being something that happens at maybe Q1, Q2, Q2, Q3 next year?
I have no idea. Yeah, I have no idea what's going to happen. I probably shouldn't try and predict because I just don't know. I
Yeah.
think we're all just along for the ride, and we're going to have to see how it plays out. But in the meantime, I think, and we obviously can't control that, right?
Oh no.
Um, and so I think in these instances, when pondering those questions, maybe it's just better to focus on the things that you can control, and what are those things you can control. You can control how much you're investing in your portfolio. You can control where you're putting that, and I think your energy is probably better spent there, just trying to find the best companies you can, or the best funds you can invest in, and figure out how you can allocate the most amount of money to them and stack those shares while you can.
Oh,
So that's really all I'm trying to focus on right now.
I mean, that's a great mindset to have. It's like a lot simpler because I've seen some people, they're talking about the bonds and TMF and TLT, and like, yeah, the bonds and stuff are down so much, but like, is that
Yeah.
where that's where a lot of people are putting their focus in right now? I don't own any bonds. I don't have any intent to, because it's taxed as regular income, and it's not really something that I could see benefiting me 15, 20 years from now.
Yeah, so that brings up a good point. So right now you'll hear a lot of people say things like, I get comments about this, I'm sure you do as well. Why would you invest in SCHD, or why would you invest in the Hershey Company or MasterCard when you can just put your money in a high yield savings account or in bonds to get a 5% plus, cash flow return? What do you say to something like that? Why would you still, with that, if that's true, why would you still choose to invest in stocks?
I I just I don't see I don't see the interest rates being the way that they are right now for an extended period of time. I see eventually, because your savings account not too long ago was barely paying you anything when you had it in it, and eventually JPAL is going to have to decrease the rates, and I don't know if that happens next year or what, but once that does happen, you know, them putting money in savings and stuff, you're not going to earn as much from it. So I would rather just have it in stock holdings that I believe in long term. I'd rather invest in a company that if I was to fall asleep for 10 years and then wake up, I know that I'm still fine.
Yeah, that's a good point, man. It really is all about the long term. So kind of expanding on that, sure, right now you're getting those sort of yields, you're getting those sort of interest rates in those type of accounts, but it may not be something that lasts forever, and
Mm.
it maybe it's just a should be looked at as a short term place to park your money, but over the long term, you feel like you'll do better in equities.
Oh, 110%.
And it's kind of like a slingshot, right? So like as we've talked about, as interest rates have kind of come up, it's pushing share prices down, or not slingshot, like a bow and arrow, but
Yeah.
that bow is being pulled back, and then as soon as they do decide to lower interest rates or cut rates again,
Mm.
it's like you're going to let that bow go, and then stocks are just going to maybe fly back up.
Yeah, I think REITs are absolutely, over the next 2 years or so, Yeah, they're beaten down right now, but Realty Income, Extra Space Storage, Vinci's another one that's really on my radar right now. It's things hovering in the 27 area. I feel that
Yeah.
all of these are just going to take off once interest rates turn around.
In the meantime, though, like while interest rates stay where they're at, or maybe, yeah, let's say they don't raise rates. Obviously, we're still seeing the impact on share prices that it's having. But do you think there's any point where those effects kind of start to subside and then stocks kind of level out after, after people kind of realize this is where it's going to be at for a while? Do you think that at any point the share price drops from the interest rates, that effect is mitigated? Or do you think that's something that just keeps on going until they decide to change direction?
I think that the economy, the consumer spending, everything is still very strong. Unemployment's still pretty low. So honestly, I don't see it just drop. And I kind of feel like that the United States economy itself is strong enough to withstand all these interest rate increases and stuff. But could it drop another 10, 20%? Yeah, I'd just buy more.
Mm, yeah. So what do you have with that said, what do you have your sight set on? Because like we said earlier, there's so many different places you can invest right now. There's so many buying opportunities and an increasing amount that we're seeing every day, but you can't buy them all. So with that said,
Mm-hmm.
what are like the top, let's say 3 to 5 positions that you're looking at stacking up? What are you prioritizing right now?
Right now, um, I'm trying to build up a cash position, and I'm wanting to have
Mm,
about 10% just on the sideline for something big happens, a big earnings falls through, and I'm able to take advantage of it. Um, but three big ones right now that I'm watching, and if it dips any further, I'm going to jump on it. Home Depot. I know they've got earnings coming up, and if they were to have any significant drops whatsoever, I would love to jump in on that. Vici Properties is another one, above 6% yield right now. They've been increasing their dividend by 7% every year with that big yield. And honestly, I've had my eye on Realty Income. They just keep buying things left and right. They keep making acquisitions, and the stock price just keeps dropping. And right now, it's just $46. It's so hard not to just pull the trigger on that.
hmm Do you already have that one in your portfolio, or would that be a new position? And I'm sorry if you mentioned that earlier. I just don't remember.
All three of those would be new ones. If I was to,
Oh,
yeah,
all three would be new. Okay.
yeah, if in my own portfolio, it would definitely be more Mastercard or Hershey.
Yeah. Yeah, I get you, man. Nice.
So, when you started investing and everything, what made you want to go to dividends? What made you want to be a dividend investor over just straight growth or just straight ETF?
That's a really good question. And I want to hear the same from you too in a moment. Because it's a good question. It's a fun question. So when I first started getting into investing and starting to take interest in it, I did start to go down the growth road. Um, the people that I was watching and the people that I was learning from at the time, for the most part, had kind of been going down that direction. And so not knowing much better, not knowing what I myself was interested in, just kind of followed suit. And as I started doing that, I did okay. I was buying some stocks like Dropbox or Virgin Galactic. I was buying these ones that I thought would, hopefully see crazy share price returns. Didn't really know what I was doing, but as I started going down that road, I just started feeling like it wasn't for me. It was temperamentally, it just didn't match. Like I felt a bit stressed, feeling like I had to constantly check up on things. And excuse me. And then somehow or another, I started learning more about dividend investing. I think just watching other creators, it was probably around the time that I'd stumbled upon guys like PPC Ian, who's the OG. PPC is the man. PPC Ian, I got to shout out my man Russ Knopf over at Dapper Dividends. I started watching a lot of him and learning from him. Um, my man Darth Dividend, JJ Buckner, The Dream Green Show, Andre Jick, Dividend Data, Dividend Bull, like the list goes on and on. I started finding more of these guys, and I just really loved what they were doing. It really resonated with me. And so that's what motivated me to start entertaining the idea of buying some dividend stocks and doing so. I think some of the first ones I bought were for better or for worse too, like AT&T. Some of them worked out, some of them did not.
Mm.
Coca-Cola, Altria Group, Johnson and Johnson, Starbucks. These were some of my first positions. Thankfully, most of them have worked out, and most of the ones that I bought when I first started, I still have today. I shouldn't say most, but a lot of the ones I do, I suppose. Um, but then, yeah, the more that I learned about dividend investing and what it was all about, the more that it really resonated with me. I really like the idea of collecting cash flow, of just having a paycheck, being given to you by these companies once a month or once a quarter. I felt that that was a more tangible thing for me and a more predictable thing than relying on a stock to move in any sort of direction. And I know dividends are not guaranteed, like that goes without saying. But it is at the discretion of the company's management and the company's board of directors to pay that dividend. So I do think it is a bit more certain and predictable than expecting the share price to go in any one direction. So that is something that really resonated with me, that I liked about it. I liked that someday down the road, I wouldn't have to sell shares of this stock, or in theory, I wouldn't have to sell shares of my stocks to benefit from them. I wouldn't have to, in retirement or when I'm ready to start using these investments to pay my bills or whatever. I like that I wouldn't have to start liquidating the portfolio to benefit from that. You know what I mean?
Mm.
And if that's true, if you don't have to sell any of your shares and you can finagle it to put yourself in a position where you're not using 100% of the income, then this portfolio, especially when you take dividend growth into account, should just grow in perpetuity. And that was something that I especially liked as well, that as time goes on, I'm not like dwindling away what I've built up in the portfolio. Instead, I'm allowing it to continue to grow, which after I'm long gone will serve to benefit the people who live after me.
Mm.
And so then you've got a multi-generational wealth situation you're looking at. And so that really was awesome to me too. But to wrap it all up here, I know I've kind of been long-winded
Mm.
on this. It's mostly just the fact that you don't have to sell any shares. Okay, it's such a tangible thing to track. You can track your projected annual dividend income and know that you're X percent away from reaching financial freedom.
Oh yeah.
It's just a very easy thing to process, which is perfect for someone like me. Um, so yeah, there was a lot of things about dividend investing that I really liked, but those were the main things. And the cherry on top is that a lot of the companies that you're buying are these sleep well at night stocks. They're ones you're familiar with, you've heard of, you know what they do. A lot of times you're a customer of those companies, and I also like that aspect as well. Procter and Gamble, Johnson and Johnson, Starbucks, Target, Coca-Cola. Drink a lot of Coca-Cola at my house. Use a lot of dish soap and laundry detergent, and probably not enough toothpaste, but we're working on that.
Oh yeah. And I mean those two big ones are kings. They've been around for a while, and being able to
Yeah.
increase their dividend during financial crisis, COVID, everything that had been happening over that time, like you cannot downplay those stocks at all. Especially Procter and Gamble. I know that's a big one in your portfolio that you love. You still trying to
Yeah, man.
build that up and make it a bigger position?
Yeah, I would say so. I think Procter and Gamble's my second largest position, right behind. No, excuse me. Procter and Gamble's my biggest position right now. It's my number one. Procter and Gamble, Starbucks, Lowe's. I don't know. Remember what my fourth one is, and then Realty Income, I think, is number five. Um, but yeah, I would love to buy some more Procter and Gamble, but it's still a little bit above my cost basis. So just right now, there's stocks I'm down on, so I'll prioritize other things right now. But when the time comes, man, you better believe I'll pick up some more shares of Procter and Gamble. But no, I want to hear from you. I mean, that was a really good question. I want to know, like, what's your version of that, but also, like, how did you even get into investing? What made you even start thinking that this was something you needed to do?
So, what made me get into it, uh, as a lot of people got into it during COVID when you're stuck at the house all the time,
Yeah,
and I was probably the worst investor my first year. I was the guy that was trying to chase penny stocks. I was trying to you know, buy these things and hope that they would go up 200 or 300%, and I was continuously checking my phone, you know, every hour on the hour almost, and it was driving me nuts. I was so stressed about it. I'm like, why am I so stressed about my portfolio like all the time? What is going on? And I was just on YouTube, and I ran into some old Warren Buffett videos. Like someone was talking about Warren Buffett, and I was like, okay, I'll see what this guy's all about. And that's when I discovered he'd had 20 right at 20% return over the last 60 years, and I was like, what is this guy doing to, you know? And his big thing is dividend investing and compounding. And I don't know if he's the one that came up with the snowball, or talking about it, or pushing the snowball effect. But
Yeah.
I did more and more research into that, and I was just blown away by pretty much everything he was saying. He was like, you know, Coca-Cola, he would talk about his acquisition of that, and I think he got in at like $3 a share, and it pays him millions and millions of dollars every year just for holding it, sitting on your hands, not really doing anything. And another person that really resonated with me was Peter Lynch, and him saying, you know, investing's like planting a seed. You know, you gotta let that seed grow into a tree. And the more and more I dove into it, I personally think that dividend investing is safer. And when things are bad, you're still getting those payments in, and you're able to use that to, you know, ultimately buy more. And as you said, you can, you know, eventually live off of what you get through your dividends. And if you play your cards right, everything is a qualified dividend. Your tax penalty might not be as bad as if you were to just have growth stocks and having to sell them for money.
Hmm. Yeah, that makes sense, man. Have you talking about Warren Buffett and the snowball? Have you read this book?
No, I have not read that. I
You have
probably
not
need
read the
to.
snowball. Oh my gosh! So I just started it. Really good book. You could see it's pretty dang thick. I started it less than a week ago. I'm already about like a third of the way into it. Really good book. If you are at all a fan of Warren Buffett and you're at all into reading, I think that's definitely one you should pick up. I think you'd really enjoy it.
I'm definitely gonna have to check that out on Amazon.
Yeah.
But yeah, the guy knows what he's doing, and he's been through it all. I think he started investing when he was like what, 14, 11 or 14 or something like that.
Yeah, I think it was like 11 or 12. But kind of to add to what you were saying, so you made some really good points. I think you and I had pretty similar points talking about just the reasons we like dividend investing. But there's a lot of people out there, and I've seen them pop up more lately, who think it's a bad way to invest, especially for people who are younger, people who have a longer time horizon. There's a lot of people who like to talk down on dividend investing. What do you think about that? What would you say to, like, I guess, the naysayers, I suppose? I'm not saying we have to prove them wrong, but I don't know. What do you think about the argument that dividend investing is not a good way to go? It's tax inefficient. The share price drops by the dividend amount on the ex dividend date. What do you think about all that stuff?
I've also seen this a lot of the time. Whenever it's a video, it says this is why I don't invest in dividend stocks or anything pertaining to that. The number one thing they bring up every single time is taxes. And if you I personally think if you do your own research, if you do your research and stuff into it, you can avoid, you know, having to pay a lot of taxes on your dividends. I mean, if you hold a qualified dividend for, was it past two X dividend dates or something, or 90 days past an X dividend date, it now becomes a qualified dividend, and your taxes on that are decreased by almost half. I don't, like I said, whenever I first started investing, I didn't even know what a dividend was, and I've never been more stressed with investing whenever I was just trying to focus on growth stocks, because with that I had the mentality of, okay, growth stock only go up, instead of dividend stock, when I can build a foundation and or plant the seed and let that grow into a tree for me. So it's when it people that hate on dividend stocks, like, or dividend investing, I don't think that they've they've either one, not fully looked into it, or two, they've gotten lucky with two or three penny stocks and have went up 800-900%, and that they're just diehard growth investors.
Yeah, some of them too. There's some people out there too who are just like, well, it's just not worth it. Like, why would you want to be a dividend investor when you can just buy like ETFs? Why wouldn't you just buy VU? Why wouldn't you just buy VTI and call it good? Which is a good question. Like, why, for the sake of simplicity, why wouldn't you just buy the S&P 500, call it a day, knowing that, well, not knowing, but with the possibility that you'll get like a 7 to 10% return over a long period of time. Is that not good enough? Most people don't beat the market, so why wouldn't you just buy the market? It seems to be the most optimal way to invest. What's the argument for straying from that? Do you think there is a good one?
For just going with individual holdings instead of just the ETF.
Yeah, or just, yeah, going with individual holdings, going with SCHD plus some individual holdings, just basically doing anything that's not just buying the market.
Um, well, I enjoy, breaking down companies, doing the research, and yeah, you can just buy the market. But my thing with, like, VU, for example, great ETF, not hating on it. But with VU, I think your top 10 positions is over 30 to 35% of the other 500 companies in there. So, 30% is into those 10. The other 70 is into the other 490 holdings. There are some of those at the main bottom where it's like not even like 0.1%. And I just, in my head, I'm just like, is that really like relevant? Like I'm having a little piece of things that I have no idea what are, when I can invest in individual holdings, invest in what I know and what I use every day, or what I just personally enjoy doing research with. And SCHD, one of the main reasons why I like it so much is it doesn't have two, three, four, 500 holdings in it. It's got, it's 110, I believe. Nice little compressed ETF, and it's got a good variety of individual holdings. Like, I think the highest one's like 4% or something. And I don't know. I enjoy doing the research. I enjoy knowing what I'm investing in. And
Yeah.
yeah.
I'm the exact same way. That's kind of like, I understand a lot of what people are saying makes sense. It's like there's pros and cons to everything for sure. Another one that people say is you won't beat the market. Well, yeah, we kind of touched on that. You won't beat the market, but it's like, you could. The more that you deviate from just investing in the market, the greater the potential that you have to, or your returns will vary from the market as well. In either direction, you could either underperform or outperform, but you have the opportunity to do either. And if you lose, you're kind of dying on your own sword. But if you win, it's like from your own good judgment, I
Mm.
suppose. So there's something to be. I don't know. That's kind of an exciting thing. Um, but at the same time, it's exactly what you said. I enjoy doing this. I enjoy looking into companies and researching companies and custom building my portfolio and cherry picking the ideas that I think are going to be good,
Yep.
not today in some cases, but 5 years down the road, 10 years, 20 years down the road. I like to make decisions based on that. And I like to say that your portfolio is kind of an extension of, I guess, yourself and how you think of the world. That's especially true when you're buying individual stocks.
Mm.
Uh, it's just a reflection of what you think is going to happen and what's going to be good down the road. And it's kind of fun to see it's kind of fun to put that together yourself and also see how others do it themselves. And so for a lot of us, it's a hobby. It's something we enjoy doing. It's certainly easier to just buy an ETF, and sure, you may not beat the market, but you also might. And at the same time, the good thing about dividend investing is, in theory, you could beat the market 0 years out of, any 0 years out of 100 years. You could beat the market no times, and you could still get to where you're trying to go, because the ultimate goal is to live off your passive income. And as long as, in theory, as long as your dividend income's growing, at some point you'll get to where you're trying to go, and you could do so without beating the market. And it'd be nice to beat the market. I'm
Mm.
not saying you shouldn't try to do the best you can, but even if you didn't, which most people don't, not even professionals with PhDs in finance, a lot of them don't.
I think 90% don't, or something like that.
Yeah, I've read different stats, but it's usually like certainly like less than 10% of people do. Um, but yeah, even if you don't, you're going to be fine.
Dividend investing, like another reason, like if the market's flat, you're still getting that cash flow and you're still, accumulating shares and everything. And it just makes me think back to the people that bought in at the beginning of like the .com bubble, because from there until like 2011 or 2013, the S&P was pretty much flat for that entire time.
Yeah.
It went up and down here and there, but it took it a long time to get back to where it was before the bubble popped. And I mean, it's another reason why, like, if you were a dividend investor during that time, just letting it build up over that 10 years, and then when things popped back off again, just reap the benefits from it.
Well said, man. You never know what's going to happen, but at the end of the day, it's fun to do this stuff. It's
No,
fun.
absolutely. So, another question for you is, I know that you have a Lowe's position. What made you pick Lowe's over Home Depot? I know those are the two big home improvement stores.
This is a good question. I knew as soon as you mentioned Home Depot that we'd be talking about this.
I love Home
Um,
Depot.
so first and foremost, I don't think you can go wrong either way, right? The two more or less operate in a duopoly in that space.
The
And so I
Coke and
don't think you can go
Pepsis.
wrong. Yeah, exactly. Very symmetrical. So I don't think you can go wrong either way. For me at the time, when I bought into Lowe's, because I was kind of looking at both. First and foremost, my growing up, my family they were at Lowe's every weekend, so had been around Lowe's for a long time, so I was a bit more familiar with it,
Mm,
and that one was a bit more close to home, which isn't why you should invest, but in general, I was a bit more familiar with it at the time. I think Lowe's was at a better valuation. I think the starting yield was higher, and the dividend growth was higher, and they had a much longer dividend growth history. The advantage that Home Depot seemed to have to me over Lowe's was their professional segment. So selling to contractors and stuff like that. They seem to have the advantage, and that seemed to be a larger percentage of their revenue compared to Lowe's.
the big.
But Lowe's, yeah. But Lowe's has been bringing that up as well. So they're growing in that department. They're really trying to make a solid effort to do so. And it seems to be working since I've been a shareholder. Their professional sales have increased, so they're working on that. And I don't know if this is answering your question at all, but
Oh no,
yeah, I
absolutely
do.
is. I mean, yeah.
But yeah, so I thought Lowe's in general better valuation. First of all, similar companies, Lowe's better valuation, better dividend stats. Papa John's.
Okay, so I wrote up a little list of random things to ask you. So if you could go back in the main beginning before you made your first deposit into investing, what one thing would you tell yourself?
Hang on. No, that's a good question. Let me think about that for a sec. So if I had to go back before I started investing a single penny,
You're
what
getting
would I
ready
tell
to make your
myself?
first deposit. You can go back and tell yourself one thing.
Oh God, man. Learn accounting.
Learn accounting.
Yeah, as quick as you can. Learn how to read financial statements. Excuse me, for anyone who's getting into investing, especially primarily if you're going to be investing in individual stocks, I think that's an invaluable tool. That's something that, because I came into this with zero experience in that department. I had no background in finance, none of that stuff. But that's such an important part of looking at businesses that can tell you so much. So I think if I had to tell myself one thing, it would be just learn that as quick as possible.
Mm.
And that's something that I'm still working at. I've been investing for a few years now. I think it'll be 4 years sometime in 2024. just learning the income statement, balance sheet, statement of cash flows, and learning how they all intersect is still a work in progress. But it's just even knowing the little bit that I do now has really helped me when it comes to looking at these companies and understanding what's going on. Um, and so that'd be the one thing, that one actionable tip if I had to give myself that's not like a more ethereal, like be patient or keep going or hang in there.
Mm.
If I had to give myself one actionable piece of advice, something that's actually usable, it'd be that.
I mean, yeah, the accounting's definitely being able to read those reports, those statements, understanding the ins and outs with them, um, super important. Mine would definitely be learn how to do analysis on stocks and don't just buy hype, because that was the worst thing I did when I first started investing. I dodged such a big could have been disaster. Whenever I first started investing, I was buying Neo at 30, high 30s, low 40s, and that's at like 6 now. And at one
Mm.
point, I had like 60% of my portfolio was into Neo, and my average was around 42. And then I finally broke even with it, and that's whenever I found dividend investing and was starting to do research into that, and luckily got out of the position literally even. And since then, Neo has dropped from 42 to, I think it's at 6, 7, 8 right now. So I
Wow.
could have absolutely decimated myself if I would have just kept that mindset. But I feel like I missed out on a lot of things too because of my first year of investing. I was so concentrated on those hype stocks. Every time you went on the news, it was, Kathy Wood's ARC funds up, 40% this week, and I got sucked into that. I was just like, oh, I want that. I want that 40% gain in a week. And if I could just go back and tell myself, no, stop, do this instead, like the way that I'm doing it now, I feel like I would be a little bit more ahead than where I am now.
Well, hindsight's always 2020, and as the saying goes, like slow and steady wins the race.
Mm-hmm.
I think it's better to have more moderate yet predictable gains. And we can't really predict, but humor me, I suppose. More moderate gains that were slow and steady than things that are volatile in either direction, because it could go either way, right? It could either go up
Absolutely.
by a long shot or down by a long shot, as you almost experienced. So that's good. That's great. But is that where the name tortoise investing comes from?
That, and I have an actual pet tortoise, and
Oh, nice.
I did have I did change my mindset to slow and steady with dividend investing. It's the way to go, and that's kind of how I came up with my name. And he was, an inspiration for it as well. He's got his little
Yeah.
enclosure in there.
And kind of to close out this point, I think that's something that a lot of new investors just have to go through. And it's an easy trap to fall into. We all want things to happen overnight. We all want things to happen sooner than later.
Mm,
Patience is a hard thing and not a lot of people, especially as it pertains to the style of investing that we do, not a lot of people would be willing to look at this knowing that it's really not going to be anything exciting until you might have to wait 5 years or 10
mm,
years or even longer. So not a lot of people would be willing to get into something like this knowing that it's going to take that long to see anything substantial. But at the same time, with dividend investing, you're met with so many small victories along the way. There's all these little milestones. And even though, we may not always beat the market, or chances are, it may be difficult to beat the market, slower and steadier gains, however you want to phrase it, man, there's a component to it that is about like competing with yourself as well, and bettering yourself. It is a pretty direct way to see self-improvement.
mm.
You know what I mean? And so each of those small victories, each of those milestones, whether it's your first dividend, your first dollar dividend, $5, $10, till you start getting up to, you're averaging $100 a month, and then $200 a month. All of those things are worth celebrating. And that's one of the cool aspects to it as well. Yeah, it does take a long time, but there are so many reasons to get excited, and you're constantly met with reminders of, number one, why you're doing it, and number two, how far you've come along the way.
And it's a good idea to keep track of everything too, so you can, see that year over year, quarter over quarter growth with your dividends. There's no better feeling than when you know, you look at your portfolio and then they just announced a 15-20% dividend
Yeah,
hike. And that's the
yeah,
thing with
absolutely.
Mastercard. Why I'm so drawn to it is they do huge dividend hikes. Yield's not that much; it's like 0.5, 0.6%,
Hmm.
but
Hmm.
big dividend hikes, and they buy back shares like crazy. And yeah, I'm about that.
Yeah, and Visa's the same way. Visa just announced a 15% dividend increase the other week.
Mm-hmm.
Um, when you're seeing a lot of other companies not announcing raises as high. So yeah, it's a really exciting thing knowing you didn't have to get anything for that pay raise. And the longer that you do this, the more substantial, the more of an impact those dividend increases will have. So it's not necessarily exciting at first for a lot of people, but you stick with it long enough, and it gets pretty cool. Like I just put out a dividend income video yesterday for the month of for this month in October, and my year over year income, this is partly because of contributions, but also dividend increases. Year over year, my income in October was like 95% higher than it was this time last year, almost a 100% gain year over year. And it's like, dang, that's a lot of progress. That feels really cool. And that's not the case every single month, but on a low end, it's like 10% higher or 15% higher, which is still not nothing.
And that's where you said, the small victories. You gotta enjoy those. You gotta take advantage of. I just love the compounding effect. I just can't get over it. Again, I need to get that book. I need to read through that.
You'll enjoy it, man. You'll enjoy it. And also, if you haven't picked up, so I mentioned like learning accounting and financial statements.
Mm-hmm.
Warren Buffett in the Interpretation of Financial Statements is another really good book that I recommend everyone check out if they want to learn more about this stuff. I
Does he
have
go
it
over
right
a
here.
bunch of like how to read statements and stuff in it? I'm assuming.
Yeah, so the authors are Mary Buffett, who I think was like his ex-daughter-in-law, and a guy named David Clark. But it's a short little book, and each page in the book or each chapter, which is 1 or 2 pages long, is a different line item on each of the income statements. So they'll go through the income statement line item by line item, revenue, cost of goods sold, gross profit. They'll explain it all the way down what it is. Do the same for the balance sheet and the statement of cash flows. So they'll explain what it is, how to use it, how it all intersects with one another. And you can just read how I do it, as I just read a chapter every single day, and I'm just gonna keep doing that as long as it takes for it to sink in. So I highly recommend everyone pick up this book. It's really good, really easy read. And if you're someone who has no experience with this stuff or learning how to read financial statements, this is a great place to start.
Did that say it's Buffettology?
Yes, it does. So they also wrote called Buffettology, which I don't have, but they wrote another one called The Tao of Warren Buffett, which is similar. I actually have that one sitting over there too. It's just a collection of his quotes, and each page they'll list the quote and then describe kind of what he means and how to apply it. But yeah, that's another really helpful book as well. Another one you could read just like a page a day and just keep doing that.
I
So
I definitely need to pick up some books. It seems because there's definitely those two, and then I think Peter Lynch has a book. It's just called Beating the Market or
yeah, Beating the Street.
Beating the Street.
Yeah, and he's got one up on Wall Street, obviously, which
Oh
is
yeah,
a classic. Hmm.
one up on Wall Street. That I mean, what he did with the Magellan Fund was ridiculous. Was it over 13 years, 29% annual return?
Yeah, I don't know what the exact number is, but what's interesting. So obviously we look to people like Warren Buffett and Peter Lynch as being, kind of the greatest of all time
Mm-hmm.
in this space. And what's interesting about them is that their portfolios look pretty different. Like while Warren Buffett's maybe has been a bit more concentrated, or that's kind of what he preaches, Peter Lynch was spread out across hundreds of different companies.
Yeah, he at one point I read they held over 1,000 different positions,
Oh
and
wow, I didn't know it was that many.
I could not imagine having to keep up with that many and having to do the research and just. And the thing that confuses me about that is he held hundreds up to 1,000 positions, but he also preached diversification. And
Hmm.
I'm sitting there, I'm like, you say one thing, but you're doing the other. But I love the guy, and I do understand his diversification thing. If you don't have the time to, do the research in all these stocks, each holdings like a game of poker, and it's easier to keep up with 6, 7, 8 instead of 100 plus holdings.
Yeah.
So are you
And I think
looking?
for everyone, sorry, man, for everyone, it's, as far as diversification goes, this is an important point because it gets brought up and asked about a lot. Like, how many stocks should you have in your portfolio? That example right there, just comparing their two different portfolios, it just depends. Everyone's different. I know some people who have north of 100 positions and do just fine, and then others who have like 15 or less, and that's preferable for them. I personally have about 20, I think 22 different holdings, and I'd say for me personally, like the sweet spot somewhere between like probably like 15 to 25, which is kind of a broad range, but that's
Mm,
a pretty good sweet spot for me as far as individual holdings go. But anyways, if for anyone wondering about diversification, how many should you have? You'll settle into your sweet spot as you develop and as time goes on. So
mm,
don't stress too much about it. You'll know. You'll be able to feel it.
you hold, you hold your what, 15, 18 positions right now. How many do you
Yeah, I
have?
think I've got 20. I think I've got 22.
22.
22 individual positions, and then I've got SCHD and VU. Yeah.
Are you looking to condense any further? Or are you kind of happy with your portfolio right now?
I'm happy with it, but I can see a few holdings that I wouldn't mind at some point consolidating out of. If I don't get the chance to, then I'm fine with it. But if I can wait and be patient and see if I can get the right share price that I want. And I'm talking positions maybe like AT&T and T and Verizon. I'm pretty like either way on them. I'm okay holding them because they're paying the nice dividend, but at the same
Yep.
time, um, I'd be okay selling out of them and consolidating. Um, Intel's another one. I think I'll get my cost basis with Intel is in the mid to low 40s right now, and I do think at some point is within a number of years I would not be surprised if I was able to get the price that I wanted for it, at least break even and then some. So I'm kind of waiting for that, but it's just stuff like that in my portfolio that I wouldn't mind selling out of. But for the most part, I've been pretty happy with my holdings, and yeah, I think I've got a good group of stocks. So
Yeah, Intel, they're building factories like crazy, aren't they? Like the future. I think Intel's got a great future ahead of them, and yeah, there's pain now. They just announced that dividend cut a couple months ago, but they are pumping out billions of dollars in these factories, and I think once those are going, once this interest rate chaos ends and normalcy is returned, I think Intel's going to be a serious player when the semiconductor industry.
yeah, and they've been a serious player. They still have a lot of the market share. It's diminishing as time goes on. Their competitors have been catching up for sure, but they still have a large percentage of the market. And we'll see. We'll see how their IDM 2.0 plans play out. But so far, it seems to be going according to plan. So as long as they stay on track, um, I think good things will happen.
Alrighty. So very quickly, buy, sell, hold. I've got a couple wrote up for you here.
Okay.
So we got Pepsi, Lowe's, Procter and Gamble. You have to buy more of one, hold one, sell one.
That's tough. Okay, so Lowe's buy, Procter and Gamble hold, Pepsi sell. And I'm not selling Pepsi because I think it's a bad company by any means. But I think Lowe's is too good to pass up right now.
Mm,
I'm certainly biased to the other two, I guess is what I should say, because I own both of them. Lowe's is definitely too good to pass up right now. Procter and Gamble, just as far as sleep well at night stocks go, to me, Procter and Gamble, it doesn't get any steadier than that. As
no.
far as staples, the products that they sell, it just doesn't get much more like you just have a constant necessity for all those things. You can't not have toothpaste or soap or deodorant or or detergent or stuff. All the stuff they sell are things you have to have. So I don't think it gets any safer than Procter and Gamble.
And they've got pricing power too. Like, if toothpaste goes up 50 cents a dollar, you can't just not buy, toothpaste, mouthwash, detergent, stuff like that. Like,
Hmm.
they've got a good grip on that entire industry.
Yeah, absolutely. Absolutely. That was a good one.
And one more I'm just going to hit you with. So, Apple, Microsoft, and Nvidia, if those were to, all three of those were to drop 50%, which one are you buying?
I'm buying Microsoft. I'm holding Apple, which I'm currently doing, and then I'm selling Nvidia.
Okay, okay. Yeah. Yeah, I really do like Microsoft long term. That is a
Yeah.
position I regret selling out of. I did hold quite a bit of it. Um, I got in at the 240s and then I sold at three. I think I sold around 340s. So, and I
Wow.
got like a really quick 30+% return on it over the course of just a couple of months because it was earlier on this year. But like,
Yeah.
if I could go back, I honestly think I would have held it. But that's when I had to, because I sold out of most of my portfolio, unfortunately, near the beginning of the year because of
Just
credit
trying
card
to
debt.
like sell at the top, or what were you?
Uh, I was drowning in credit card debt, and
Okay.
I only had one way to turn, and it was to that, unfortunately. But now,
Yeah.
credit card debt free, house is paid off, my vehicle is going to be paid off next year, and I have just been focusing everything I can into my portfolio, building it back up to where it was. But I think I sold everything in May, middle end of May. But yeah, it just got to the point where I didn't know what else to do, and
Yeah.
that did take off a lot of stress. But
Yeah.
it did set me back like a couple months.
Oh, that's okay. Couple months, that's no big deal, man. You know what you did? You took one step back to take two steps
Mm,
forward. Now that you have all these bills taken care of, the house, we kind of talked about this already, but
yep.
the house being paid off, I can't imagine how freeing that must feel, how much weight has been lifted off your shoulders. Because that's everyone's biggest expense usually.
Yep.
And you've just unlocked so much investing power from
Mm.
making all those moves. So I'm jealous actually.
Owning and not renting because we were
Yeah.
renting for a while, and that was, yeah, just driving us crazy.
Hmm.
But we racked up a lot of money from from our old Pokemon card collection, and
Nice.
we had about 40 grand in that, and that's actually what we used for the big chunk of the house, and just really went into just paying this off as quick as possible. We sold half of our stuff to do so because we didn't want to have a big house payment that we had to worry about on top of all the other things. So I had to let go of a lot of things I've held on to for years and years, but I feel like it was worth it in the long run.
Sometimes it's hard to consolidate some of those possessions.
Mm,
But at the same time, man, it feels good to travel light and not have as much stuff. I personally, I just I feel a bit heavy. I feel a bit bogged down when I have too much stuff. You know what I mean? Whether it's clothes or just like knickknacks or whatever, it's just I don't know. It feels good to keep it simple.
we realized that with our move, like, because whenever we moved, it was just like we just kept boxing stuff up. We're just like we didn't even know we had half the stuff that we had.
Yeah. No, that's a key indicator right there. If you are looking at stuff and it's like I didn't even know we have this, or it's like I completely forgot about it, then it's like yeah, probably don't need it.
There's still a couple boxes in the garage. Again, it's just like we don't know what to do with it. But
Yeah.
back to like I'm a big Pokemon fan. I've been
Hmm.
thinking about getting back into collecting. Honestly, it's not a bad investment to hold a couple of some of these. Are there anything that you buy that's got like a lot of value that you besides investing, maybe something that you can put and set back 10, 15 years and be worth a bit more?
Um, Not really. I do some real estate outside of stocks too, so I do have my hand in that. Not much, but some. I started getting into watches maybe about 6, 8 months ago. Um, but most of the watches I have are pretty cheap. So no, I don't see those being anything that I can like trade down the road for a higher value. But no, it's pretty much just stocks for me. Outside of investing, I'm into like health and fitness and working out and stuff like that. But
Mm.
that investing, hanging out with my lady and my cat, those are kind of my big things.
Nothing like family, man.
Hmm.
Do you have anything you'd like to randomly throw at me?
Um, no, not really, man. I appreciate you inviting me to do this. Yeah, it's always just fun to be able to talk stocks. I think a lot of us just in our own, lives don't really know anyone that we can talk about this stuff with. So it's good to have the community that gets it. And so I always enjoy these conversations. And like I said, I really appreciate you having me on and taking the time to chat. It's cool.
Oh, absolutely. That was the thing with me. There's no one. That's a big reason why I started the YouTube channel. Just
Yeah.
kind of a way to talk to other people about it because there's no one else here to really chit chat with when it comes to that. So I appreciate you taking the time and everything today. Sit down, talk with me, and everything.
Yeah. No, anytime, man. I'm always down to do stuff like this.
Alrighty. Well, I appreciate it, and I hope that you have a great evening, man.
You too.